Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Wish you all a very happy Diwali. We are celebrating a major milestone, the 300th episode of Investors Hangout. We want you to be a part of this special episode. Share your experience with us. Record a short video sharing how Investors Hangout has helped you, and you could be featured in our 300th episode. Share your videos with us on vrhangout@valueresearch.in. On Diwali, it's not just our home that needs a fresh beginning, but our portfolios could use a little cleaning too. So in this episode, let's learn from Dhirendra Kumar how to revamp your portfolio this Diwali. Welcome, Dhirendra.
Thank you.
So let's begin this conversation with our first question. What are the most common signs that an investment is underperforming and should be removed from a portfolio?
It's fairly straightforward when it comes to mutual fund. A fund which has not beaten its benchmark over the last 3 years, or a fund which has, a fund managed by a very old, reputed fund manager and has not done well over the 5 years. I give up. I don't really look any further. Simply because, there are other options. And making sure that, it's a diversified vehicle, it's a low-cost vehicle, and all those things, so looking at the hygiene of a fund and beating the benchmark consistently. And if not consistently, at least for these two longer periods, is my first stop. Looking at your stock portfolio is complicated. You have to look at whether it's a great company. Is it growing well? Is it too expensive? Or it just has the momentum. There are great companies which they refuse to move for many years. Or there are very poor companies. So, you need to, it's complicated and we could be very helpful. Value research could be very helpful.
Okay. So moving on, how should investors go about deciding which assets to keep and which to let go of while cleaning their portfolios?
Most of the time, investors are getting excited about the recent performance, how your investment has done in recent time, 6 months, 1 year, 2 years. But I would say that, look at your portfolio in a more holistic way. Make sure that you have some meaningful position in a fund so that if it does well, you benefit a lot. I would like to do 2 very simple things. For my mutual fund portfolio, I would like to have a meaningful exposure. A position should be 7.5% to 10%, simply because, it's a diversified portfolio. Ideally, you should buy a fund invest in a fund which you don't have to necessarily make changes often. So make sure that it's a diversified vehicle, a value fund, a large and mid-cap fund, or a flexi-cap fund, or a multi-cap fund. But make sure that, they have beaten their benchmark over a 3-year period, 5-year period, and Value Research Online gives you this number right there. Second is that when you have a stock, you have to make sure that it is at least have some meaningful position, 2%, 2 to 5%. Because what is the point of investing in a stock that it does exceptionally well and it is 0.025% of your portfolio, you have bought, some 10,000 rupee and it becomes 40,000 rupee, but it really doesn't make a difference to you overall. So make sure that, worry about these things more. Value research really makes it very easy for you. You can upload, just with your PAN number and phone authentication with the OTP on your phone, you are able to import your investments, all your investments from the depositories as well as all the fund companies, MS Central. And in a couple of minutes, your portfolio is live on Value Research Online. That makes monitoring and tracking and reviewing and analyzing your portfolio a breeze. What happens is you are able to look at all the, how much of your investment in a fund, what percentage it is, how it has done, has it beaten the benchmark, has it not beaten the benchmark, what is the rating of the fund. Based on that, drop everything which is less than 5%. That makes it easy. When it comes to stock, you get the rating, you get the valuation grade, you get the growth grade, you get the quality grade, and you get the momentum grade. Based on this, you can quickly decide what to sell. And what you don't sell, make sure that, if it's a mutual fund, it becomes 10% of your portfolio. If it is a stock, it becomes 3 to 5% of your portfolio.
Okay, so to wrap up this conversation, what is your Diwali pick this year?
Clean it up and you will have money, and invest more in these ones. So you will have a happier Diwali next year. Second is that, once in long-term investment should not be planned on a Diwali to Diwali, Muhurat trading, this, that. If you have a great plan, you will have a great Diwali many, many years. If at all you have this urge to invest in Diwali, a Muhurat trading investment, Think of a stock which you will keep buying for next 10 years. You like it so much. And then you will do a 20-year SIP every Diwali or maybe sometime in between when you get bonus. Choose one or two such stock. And maybe, value research can be very helpful finding that stock as well. When it comes to mutual fund, if you are able to, frame your rules, clean your portfolio, reorganize everything, make sure that, you resist the urge to, add something just because there's a great story. It looks compelling. Somebody is telling you, you're looking at the hoarding, you're looking at the front page of newspapers today come with a mutual fund ad. And they force you to, or they actually, provoke you to think that you must invest in these. You don't need to. If you have a great portfolio, if you have a diversified portfolio and have a couple of them, and if you have a long-term orientation, you will be very well off.
Okay. So now it's time for the viewer's question. Pramod asks, as the market is crashing, is it the right time to redeem all mutual funds?
If you need your money anytime in the next 6 months, 1 year, 2 years, 3 years, you need to plan it. If it is invested for the long run, you don't have any need for this money for a couple of years, you should remain invested. In fact, use this opportunity to invest a little more if at all you have money. Be on a systematic plan. Otherwise, if you have little extra money lying somewhere, use this opportunity because over a longer period of time, markets will go up. And in between, there will be many, many such declines. And if you try to get out of it, you will make your, you will lose out on the great opportunity which equity or a diversified equity portfolio or the India story that offers you. So the plan has to be very straightforward. If you need your money in 6 months, take all your money out. If you need your money in 1 year's time, take half of it right away. You still will be sitting on profit. If you need your money in 2 years' time, take 25% of that money and be methodical about it. What we keep saying is that invest regularly. Likewise, disinvest regularly before you need it. You can't be waiting on the last day when you need the on the market when you need the money.
Okay. Well, we hope that answers your question. That's all for today's episode. Keep watching the show for more information.